Today, we're diving into an important element of personal finance, the individual income tax. This topic affects anyone with income, from young adults just starting their careers to retirees. Understanding how your income is taxed can help you make more tax-savvy planning decisions. Income tax is what you pay on the taxable income you earn or otherwise receive throughout the year. This may include different sources such as wages from your job, profits from a business, retirement benefits, and earnings or gains on investments. The government uses this tax to pay for services and infrastructure like education, healthcare, and public safety. In many countries, including here in the US, income tax is progressive. This means that the more you earn, the higher the rate at which you're taxed. These rates are organized into what we call tax brackets. Each bracket corresponds to a portion of your income and is taxed at a specific rate. For example, a single individual with $40,000 of taxable income will pay 10% tax on the first $10,000 and 12% tax on the next $30,000 as it falls into the 12% bracket. Only the dollars within each bracket are taxed at that bracket's corresponding rate. The top rate you pay on your last dollar of income is your marginal tax rate. However, because of the brackets, your effective tax rate is the percent of total tax you pay on your total income. This is always lower than your marginal tax rate because it is a blend of each of the rates up to and including your top marginal rate. It's important to understand both your marginal tax rate and effective tax rate. The effective rate is helpful when estimating how much you should be budgeting for your tax expense. The marginal tax rate is the actual amount of tax you will save on any additional tax deductions or pay on your next dollar of income. Now let's dive deeper into reducing your tax bill through deductions and credits, both vital tools in tax planning. Deductions reduce your taxable income, effectively lowering the amount of income subject to tax. Common examples include contributions to retirement accounts, mortgage interest on your home, and charitable donations. By reducing your taxable income, deductions can lower your overall tax obligation, placing you into a lower tax bracket in some cases. Tax credits are even more powerful than deductions because they reduce your tax on a dollar-for-dollar basis. Think of them as direct discounts off your final tax amount owed. Examples include credits for education expenses and energy-efficient home improvements. Since they apply directly to reduce the tax you owe, they can significantly lower your effective tax rate. In addition to income tax, payroll taxes are required on any wages, salary, tips, or other earnings from employment and are deducted directly from your paycheck. These payroll taxes are a flat rate on earnings up to a certain limit and are used to fund government programs such as Social Security and Medicare. The total tax is 15.3%, split evenly between an employer and an employee, meaning each pays a tax of 7.65%. For those who are self-employed and don't have the benefit of an employer paying half of the tax, they instead pay the full amount through the self-employment tax. However, self-employed individuals are allowed to deduct half the self-employment tax from their taxable income, providing some tax savings. Income generated from your investments, such as interest, dividends, and capital gains, have varied tax treatments. Capital gains occur when you sell an investment for more than you bought it for. If you sell an asset within a year of buying it, you will have a short-term capital gain, which is taxed as ordinary income. However, if you sell an asset after holding it for more than a year, you have a long-term capital gain, which is taxed at a lower rate. These rates can be as low as 0% or as high as 20%, depending on your income. Interest and dividend income may be taxable as ordinary income or may qualify for a lower preferred rate. Examples include interest paid on municipal bonds, which is tax exempt, and qualified dividends paid by corporations, which are taxed at capital gains rates. Every year, you need to submit a tax return that shows your income and deductions, which determines how much tax you have to pay or how much of a refund you are owed. You have until April 15th to file your tax return, unless you apply for an extension, which gives you 6 more months to file. However, an extension only delays the deadline for filing your return, not for paying taxes. You still need to pay all the taxes owed for the year by April 15th. Your tax return lists all of your taxable income, deductions, and credits for the year, and helps you reconcile the amount of tax you've paid throughout the year with your actual tax liability. If you overpaid your taxes during the year, you would receive a refund. If you underpaid your taxes, you would have to pay the rest, possibly a penalty for underpayment. Withholding and estimated taxes are important aspects of tax management. The government expects individuals and businesses to pay a portion of their taxes owed throughout the year. This can be done either through withholding, for example, the taxes taken out by your employer and shown on your W-2 at year end, or through estimated tax payments you make yourself every quarter using a tax payment voucher. Many self-employed individuals or those with income from various sources are familiar with making quarterly estimated tax payments. Paying the appropriate amount of taxes through withholding or quarterly estimates can help reduce the amount owed come tax day and avoid penalties and interest due to underpayment. While understanding the basics of income tax is essential, the tax code can be complex and ever-changing. Working with a qualified tax advisor or accountant can be critical, particularly when you have multiple sources of income, complex deductions, or run a business. A qualified professional can provide personalized advice, help navigate the complexities of tax laws, ensure compliance, and often find opportunities to save on taxes that you might not be aware of. They're an investment in your financial health and peace of mind.